While markets celebrated record highs, a quiet financial revolution unfolded in Toronto that exposed how Canada's economy is defying every prediction about trade war devastation. But the truth behind this resilience reveals a far more dangerous gamble than anyone realizes. Let's begin. The brewing economic tension you've sensed between Canada and the United States has reached a critical inflection point that most investors are completely misreading. What appears to be Canadian economic strength is actually a sophisticated form of financial theater, masking an economy that's fundamentally restructuring itself in real time to survive an unprecedented trade assault. Since February 2025, when President Trump imposed his first wave of tariffs, Canada has been operating under what economists privately call crisis capitalism, a state where normal market mechanisms are suspended in favor of emergency economic management. The $1 trillion annual trade relationship between the two countries, built over more than a century, is being stress-tested in ways that have never been attempted between allied nations. The Toronto Stock Exchange, which closed at a record high today, represents the epicenter of this economic experiment. With 27,993.43 points, the S&P/TSX Composite Index is trading at levels that seem to mock the dire predictions made when Trump's tariff war began. But this isn't the triumph of Canadian resilience that headline writers are celebrating. It's the opening act of a much more complex and dangerous economic drama. What you're witnessing is an economy that's learned to function despite having its primary economic relationship weaponized against it. Canadian businesses, investors, and policymakers have spent the past 6 months developing survival strategies that assume permanent economic warfare with their largest trading partner. The market surge today reflects not confidence, but the early stages of a fundamental economic pivot that could reshape North America forever. By understanding what's really driving today's market action, you're seeing something that most investors and analysts are missing: the emergence of a post-American Canadian economy that's being born out of necessity and desperation. The strategic backdrop you now understand has created the perfect conditions for what market analysts are calling the Great Canadian Contradiction. An economy that's simultaneously weakening and strengthening in ways that defy traditional economic logic. Throughout the summer of 2025, Canadian markets have been operating in a strange parallel universe where bad news has become good news, and economic uncertainty has fueled investor optimism. The key to understanding this paradox lies in what's happening beneath the surface of today's record-breaking performance. Canadian companies have spent the past 6 months engaging in what economists call defensive diversification, frantically restructuring their operations to reduce dependence on American markets while seeking new revenue streams in Europe, Asia, and Latin America. This process, while painful in the short term, has created unexpected opportunities that smart investors have been quietly capitalizing on. The corporate earnings driving today's surge tell this story in stark detail. Gildan Activewear's 11.8% jump after announcing its $2.2 billion acquisition of American undergarments maker Hanesbrands represents more than just a business deal. It's a strategic play to gain control of U.S. manufacturing assets, while American companies are distracted by domestic political concerns. Similarly, Hudbay Minerals' 14.8% surge following the sale of a 30% stake in an Arizona copper project to Mitsubishi for $600 million reflects a broader trend. Canadian resource companies are liquidating American assets while they still can, converting them into cash that can be deployed in more stable jurisdictions. The financial sector's 0.7% gain today masks a more complex reality. Canadian banks have been quietly reducing their exposure to cross-border lending while increasing their focus on domestic real estate and international expansion. The 1.3% jump in real estate stocks reflects this internal reallocation of capital, as investors bet that domestic Canadian assets will become more valuable as the economy turns inward. But perhaps most significantly, the 1% decline in technology stocks reveals the sector where the trade war's impact is most clearly visible. Canadian tech companies, which had been heavily integrated with American supply chains and customer bases, are struggling to maintain growth as cross-border business relationships become increasingly politicized. You've now uncovered the sophisticated financial engineering that's driving today's market performance, and why this apparent strength may actually signal the beginning of something far more dramatic than a simple trade dispute. If you're enjoying our video, consider subscribing to our channel. The critical moment you've been anticipating arrived at exactly 4 p.m. Eastern Time on Wednesday, when the closing bell at the Toronto Stock Exchange marked not just another trading day, but a historic milestone that reveals how financial markets can surge even as the fundamental assumptions underlying an entire economy collapse in real time. The S&P/TSX composite indexes climbed to 27,993.43 points, a gain of 72.17 points, or 0.3%, represents the highest closing level in Canadian market history. But the true significance of this achievement only becomes clear when you examine the specific forces that drove the rally and what they reveal about Canada's economic transformation. The day began with cautious optimism following Tuesday's U.S. inflation data, which showed consumer prices increasing only marginally in July. This data reinforced expectations that the Federal Reserve would cut interest rates in September, providing relief to Canadian companies struggling with the dual burden of trade uncertainty and high borrowing costs. But as trading progressed, something more fundamental began driving the market action. Gildan Activewear emerged as the star performer, with shares rocketing 11.8% on news of its agreement to acquire Hanesbrands for $2.2 billion. At first glance, this appears to be a routine corporate acquisition. But industry insiders understand the strategic brilliance of the move. Gildan is essentially buying American manufacturing capacity and brand recognition at fire sale prices, while American companies are paralyzed by political uncertainty and trade disruption. This isn't just about expanding market share, explained one textile industry analyst who requested anonymity. Gildan is positioning itself to control apparel supply chains on both sides of the border, regardless of what happens with trade policy. They're essentially betting that economic integration will continue at the corporate level, even if it breaks down at the government level. The Hudbay Minerals story adds another layer to this narrative. The company's 14.8% surge following the announcement of its $600 million stake sale to Mitsubishi represents a broader trend that few observers have fully grasped. Canadian resource companies are systematically liquidating their American assets, while global demand for critical minerals remains strong, then redeploying that capital in jurisdictions with more stable political environments. The financial sector's performance today tells an even more complex story. The 0.7% gain masks a fundamental shift in Canadian banking strategy that's been months in the making. Major banks have been quietly reducing their exposure to cross-border lending, particularly in sectors likely to be affected by ongoing trade disputes. Instead, they're focusing on domestic real estate markets and international expansion in Asia and Europe. Royal Bank of Canada, which posted modest gains today, has been particularly aggressive in this reallocation. The bank has reduced its U.S. commercial lending portfolio by an estimated 15% since March, while increasing its presence in wealth management markets across Asia. This strategic pivot is being rewarded by investors who understand that geographical diversification has become a survival strategy rather than a growth opportunity. The broader market's ability to shrug off tech sector weakness reveals something crucial about investor psychology in the current environment. Market participants have essentially written off the sectors most dependent on U.S. integration, while rewarding companies that demonstrate clear strategies for operating in a post-integration North American economy. Colin Siashinsky, Chief Market Strategist at SIA Wealth Management, captured this sentiment perfectly. We're seeing equity markets continue to do well. People remain confident the economy has held up, and inflation has not taken off as much as people thought. But beneath this confidence lies a more calculated assessment. Investors are betting on Canada's ability to function as an independent economic entity, regardless of what happens with trade relations. What you're witnessing is financial markets that have essentially given up on the traditional Canada-US economic relationship and are instead pricing in a new reality where Canadian companies succeed by reducing their dependence on American markets rather than deepening it. The aftershock from today's record-breaking performance becomes clear when you examine how Canadian business leaders and policymakers are interpreting these results. Not as validation of current strategy, but as confirmation that their most pessimistic assumptions about the future of North American trade were correct. Within hours of the market close, corporate boardrooms across Canada were buzzing with a mixture of relief and apprehension. The record high provides political cover for CEOs who have been making dramatic strategic pivots over the past 6 months. But it also raises uncomfortable questions about what happens when the current momentum runs out. The market is rewarding us for making hard decisions quickly, said one Fortune 500 CEO who requested anonymity. But we all know this is a sugar high. The real test comes when we have to demonstrate that our new strategies can actually generate sustainable growth without the U.S. market. The immediate corporate response to today's surge reveals the depth of this strategic uncertainty. Rather than celebrating, most major Canadian companies used the positive market sentiment to accelerate their diversification efforts. Several firms announced expanded operations in Asia and Europe, while others used the improved stock valuations to raise capital for domestic investments. Shopify, despite seeing its shares decline in today's tech sell-off, announced after markets closed that it would be opening new development centers in Dublin and Singapore, while reducing its workforce at U.S. facilities. The company framed this as global expansion, but industry insiders understand it as preparation for a world where cross-border data flows, and business relationships become increasingly restricted. The resource sector's response was even more dramatic. Barrick Gold used today's positive sentiment to announce a new joint venture with European mining companies, while Canadian Natural Resources revealed plans for expanded operations in Norway and the North Sea. These announcements, timed to take advantage of today's market optimism, represent a fundamental shift in how Canadian companies view their role in global markets. But perhaps the most significant immediate response came from the financial sector, where today's gains provided cover for banks to announce additional provisions for trade-related losses. TD Bank revealed after markets closed that it had set aside an additional $500 million to cover potential losses from cross-border lending, while BMO announced new lending partnerships with Asian development banks. Government officials were quick to claim credit for today's performance, with Finance Minister Chrystia Freeland issuing a statement praising Canadian economic resilience in the face of unprecedented challenges. But private conversations with senior civil servants reveal a different perspective. Today's market performance is being viewed as a temporary reprieve that provides political space for even more dramatic policy interventions. International reaction was swift and telling. European investment funds, which have been quietly increasing their Canadian holdings over the past 6 months, used today's performance to justify additional investments. Asian markets, which had been skeptical of Canadian economic prospects, began showing renewed interest in everything from Canadian bonds to real estate investments. You now possess the insight that others are missing. Today's market triumph is being interpreted by Canadian leaders not as reason for optimism about trade relations, but as proof that Canada can survive and even thrive in a post-American economic environment. The unresolved forces unleashed by today's market performance reveal a truth that most observers are still missing. This record high doesn't signal the end of Canada's economic crisis, but rather marks the beginning of the most ambitious attempt at economic transformation in Canadian history, with consequences that will reshape North America for generations. What you're witnessing is the financial market's endorsement of a radical hypothesis: that Canada can decouple its economy from the United States while maintaining its standard of living and global competitiveness. This bet, reflected in today's record-closing high, represents one of the most significant economic experiments of the 21st century. The success of this transformation will depend on Canada's ability to execute three simultaneous revolutions: geographic diversification of trade relationships, technological independence from American systems, and financial autonomy from U.S. capital markets. Each of these challenges would be daunting under normal circumstances. Attempting all three while managing ongoing trade warfare represents an unprecedented test of economic resilience. The geographic diversification challenge is already showing promise, but at enormous cost. Canadian companies are spending billions of dollars to establish new supply chains and customer relationships in Europe, Asia, and Latin America. The Trans-Pacific Partnership, which Canada has embraced more enthusiastically since trade tensions began, is providing some relief, but the process of replacing the U.S. market, which represents 75% of Canadian exports, will take years and require massive infrastructure investments. The implications for the United States are equally profound, though less well understood in American political circles. Canada has historically served as America's most reliable economic partner, providing not just trade volume, but also serving as a testing ground for American companies expanding globally. The loss of this relationship will force American businesses to develop more expensive and complex international strategies. Perhaps most significantly, Canada's success in economic decoupling could provide a template for other American allies who are growing uncomfortable with U.S. economic dominance. Mexico, which faces similar trade pressures, is already studying Canadian strategies for diversification. European allies, despite their official support for free trade, are quietly developing contingency plans based on the Canadian model. For global markets, today's Canadian performance represents a proof of concept that medium-sized economies can successfully resist economic pressure from superpowers through strategic diversification and technological innovation. This lesson will not be lost on other countries facing similar pressures from China, the United States, or other major powers. What you now fully understand, and why this insight matters, is that today's record high represents more than just a good day for Canadian investors. It marks the moment when financial markets endorsed the most ambitious attempt at economic independence in modern history. The success or failure of this experiment will determine not just Canada's future, but whether middle powers can maintain economic sovereignty in an era of increasing great power competition. Stay alert for what happens next, because if Canada succeeds in this economic transformation, it will inspire similar efforts around the world, fundamentally altering the global economic system that has dominated since World War II. The next big story that you missed today is how Canadian travelers are executing a devastating economic boycott that's quietly crippling American tourism infrastructure while revealing the true psychological cost of Trump's annexation threats. But before we start on that, make sure you're subscribed to our channel. The economic warfare you've been tracking between Canada and the United States has spawned an unexpected front that most analysts are completely overlooking. A grassroots consumer revolt that's systematically dismantling one of North America's most profitable service industries through the simple act of Canadians refusing to vacation in America. This isn't just about reduced tourism numbers. What's unfolding represents the weaponization of consumer choice on a scale rarely seen between allied nations. Canadian families, who have traditionally treated the United States as an extension of their domestic travel market, are making purchasing decisions that collectively represent billions of dollars in lost American revenue. The foundation of this boycott lies in a relationship that has defined cross-border leisure travel for generations. Canadians have historically been America's most reliable tourists, predictable, high-spending, and geographically concentrated in ways that made entire regional economies dependent on their annual migrations south. Border cities from Maine to Washington state have built their economic models around the assumption that Canadian visitors would continue arriving regardless of political tensions. But Trump's casual threats to annex Canada as the 51st state, combined with the ongoing tariff war, have shattered assumptions about Canadian loyalty that took decades to build. What you're witnessing isn't just economic pressure, but the emergence of economic nationalism expressed through vacation choices. The latest statistics. Canada data reveals the scope of this transformation. Canadian road trips to the United States dropped 36.9% in July 2025 compared to the previous year, while air travel declined 25.8%. These numbers represent the 7th consecutive month of decline, suggesting this isn't a temporary reaction, but a fundamental shift in Canadian consumer behavior. By understanding the real drivers behind this boycott, you're seeing something that American tourism officials are desperately trying to downplay: the emergence of sustained economic warfare at the consumer level that could permanently reshape North American travel patterns. The strategic backdrop you now grasp has created perfect conditions for what tourism economists are privately calling the Great Canadian Exodus, a consumer revolt that's amplifying the economic damage from official trade disputes in ways that neither government anticipated or can easily control. Throughout 2024, Canadian travel to the United States had been recovering strongly from pandemic-era lows. Tourism officials on both sides of the border were celebrating record bookings and increased spending as the relationship appeared to normalize. American resort destinations, border shopping centers, and entertainment venues had become increasingly dependent on Canadian visitors who typically spent 30–40% more per trip than domestic tourists. The first cracks appeared in February 2025, when Trump's initial tariff announcements coincided with a noticeable drop in Canadian advance bookings for spring and summer travel. Tourism industry insiders initially dismissed this as temporary uncertainty that would resolve once the political situation stabilized. They were catastrophically wrong. By March, when Trump's annexation rhetoric intensified, Canadian travel agencies began reporting unprecedented cancellation rates. But this wasn't just about political anger. Economic factors were creating a perfect storm that made American travel increasingly unviable for Canadian families. The Canadian dollar's weakness against the greenback, combined with persistent inflation and housing costs at home, had already stretched household budgets to breaking points. The psychological trigger came when Trump announced the 35% tariff increase in July, accompanied by renewed suggestions that Canada should simply join the United States to avoid trade complications. For many Canadians, this represented not just economic pressure, but an existential threat to national sovereignty that demanded a personal response. What followed was a cascade of consumer decisions that revealed the depth of Canadian anger in ways that traditional polling couldn't capture. Families began canceling long-planned vacations. Shopping trips to outlet malls were abandoned. and even business travel was scrutinized for ways to avoid American destinations. The data released Tuesday by Statistics Canada represents the culmination of this psychological shift, showing that Canadian consumer behavior has fundamentally changed in ways that may prove impossible to reverse quickly. Air Canada reported that bookings between Canada and the U.S. for April through September are down 10% year over year, while 45% of Quebec residents have cancelled or reconsidered planned U.S. trips for 2025. You've now uncovered how political tensions have created economic pressures that are transforming discretionary spending patterns across an entire nation, with consequences that extend far beyond the tourism sector. Just a reminder to subscribe to our channel if you enjoy our content. The critical moment you've been anticipating crystallized in the release of Statistics Canada's July travel data on Tuesday, revealing numbers that expose how consumer-level economic warfare can devastate entire industries more effectively than any government policy, and why American tourism officials are scrambling to contain damage they never saw coming. The headline figures tell only part of the story. Canadian residents making return trips to the United States by car dropped 36.9% in July 2025 compared to July 2024, while air travel returns declined 25.8%. But these statistics mask a more complex transformation that reveals the true power of coordinated consumer action. The geographic distribution of this decline exposes the devastating precision of the Canadian boycott. Border cities that have built their economies around Canadian shopping tourism are experiencing what local officials describe as an economic catastrophe. Bellingham, Washington, which typically sees 40% of its retail revenue from Canadian visitors, reported a 60% decline in cross-border shopping during July. Maine's tourism industry, heavily dependent on Canadian families visiting coastal resorts, is facing its worst season in decades. "We've never seen anything like this," said Maria Santos, Director of Tourism for Whatcom County, Washington. "Canadian families aren't just reducing their visits, they're actively avoiding us. These are people who've been coming here for generations, and now they're telling us directly that they won't return while the current political situation continues." The psychology driving these decisions reveals something profound about how trade disputes can trigger cultural and emotional responses that go far beyond economics. Focus groups conducted by Canadian tourism researchers show that many families view continued American travel as implicit endorsement of Trump's annexation threats and trade policies. Jennifer Morrison, a teacher from Halifax, exemplifies this sentiment. "We used to take the kids to Disney World every other year. It was our big family tradition. But I can't justify spending thousands of dollars in a country whose president thinks we should just disappear as an independent nation. We're going to Europe instead." This individual decision, multiplied across millions of Canadian households, represents a massive reallocation of tourism spending that American destinations are struggling to replace. European tourism boards have reported significant increases in Canadian bookings, with destinations like Iceland, Ireland, and Portugal seeing 40 to 50% growth in Canadian visitors during the same period that American travel declined. The air travel data reveals an even more sophisticated pattern of avoidance. Canadian business travelers are increasingly routing international trips through European hubs rather than traditional American connection points. This shift is costing American airlines millions in revenue from transit passengers while boosting carriers like Lufthansa, KLM, and Air France. The economic multiplier effects are becoming visible across American border regions. Hotels that typically operate at 80 to 90% capacity during summer months are struggling to reach 50%. Restaurants, gas stations, and entertainment venues that depended on Canadian visitors are laying off staff and reducing hours. Some businesses are facing bankruptcy, but perhaps most significantly, the boycott is demonstrating remarkable persistence. Traditional tourism boycotts typically fade as political tensions ease or as consumers prioritize convenience over principles. The Canadian boycott shows no signs of weakening, despite some stabilization in official trade discussions. Isabelle Sally, an associate professor of behavioral macroeconomics at the University of Ottawa, explains this persistence. There is a growing disconnect between the economy in Canada and the state of the economy in the U.S. People have directly lost in terms of purchasing power. The uncertainty of the trade war and fears about future job losses are keeping people from spending money on leisure now, just in case. The data also reveals how economic nationalism can spread through social networks. Canadian social media is filled with posts from families proudly showcasing alternative vacation destinations, creating a cultural momentum that reinforces the boycott. Travel agents report that Canadian clients are specifically requesting non-American options for international trips. The American response has been fragmented and largely ineffective. Tourism boards have launched advertising campaigns emphasizing American-Canadian friendship, while some destinations have offered special deals for Canadian visitors. But these efforts have largely failed because they misunderstand the fundamental nature of the boycott. This isn't about price sensitivity or convenience, but about national identity and political resistance. What you're witnessing is consumer behavior that has acquired its own momentum, independent of the original political disputes that triggered it. Canadian families have discovered that avoiding American travel doesn't require significant sacrifice. Alternative destinations offer similar experiences while allowing them to express their political values through their spending choices. The aftershock from Tuesday's devastating travel statistics has triggered panic responses across American tourism infrastructure that revealed just how dependent entire regional economies had become on Canadian visitors and how unprepared they were for the psychological dimensions of economic warfare. Within 24 hours of the Statistics Canada release, emergency meetings were convened in tourism offices from Seattle to Miami, as officials grappled with revenue projections that had become completely detached from reality. The Niagara Falls Tourism Board, which typically sees Canadian visitors comprise 60% of its total volume, announced immediate budget cuts and staff layoffs after projecting a $200 million revenue shortfall for 2025. The cruise industry's response was particularly dramatic. Major cruise lines that operate from American ports announced route changes and capacity reductions after Canadian bookings collapsed. Royal Caribbean revealed that Canadian passengers, who typically represent 15 to 20% of their North American cruise volume, had dropped to less than 8% for summer 2025 sailings. American hotel chains with significant border region exposure began emergency restructuring within hours of the data release. Several major properties in Vermont, New Hampshire, and upstate New York announced seasonal closures, an unprecedented step that reflects how completely their business models had been built around Canadian tourism patterns. But the most telling immediate response came from American politicians representing border districts, who suddenly found themselves dealing with economic devastation that hadn't been anticipated when trade policies were developed in Washington. Representative Sarah Thompson from Maine's 2nd District issued a statement calling the tourism decline an economic emergency and demanding federal assistance for affected businesses. The retail sector's response revealed the breadth of economic integration that was being systematically dismantled by Canadian consumer choices. Outlet malls near the Canadian border, which had built their business models around Canadian shopping tourism, reported catastrophic revenue declines. The Woodbury Common Premium Outlets in New York, traditionally a destination for Canadian shopping trips, announced the closure of several stores and reduced operating hours. Meanwhile, Canadian travel industry responses exposed how domestic businesses were adapting to redirect tourist spending within Canada or toward non-American international destinations. Air Canada announced expanded service to European and Asian destinations while quietly reducing capacity on cross-border routes. Canadian travel agencies reported record bookings for domestic destinations as families redirected vacation budgets toward exploring their own country. The currency markets reflected these shifts within hours, with the Canadian dollar showing unusual stability despite broader economic uncertainty. Currency traders noted that reduced travel spending in the United States was improving Canada's current account balance, partially offsetting trade disruptions in other sectors. European tourism boards moved quickly to capitalize on the Canadian boycott, launching targeted marketing campaigns that explicitly positioned European destinations as alternatives to American travel. Tourism Ireland's Discover Ireland Instead campaign, launched just 48 hours after the Statistics Canada data release, directly addressed Canadian families looking for English-speaking vacation alternatives. The psychological momentum became self-reinforcing as Canadian media coverage celebrated families who had discovered alternative destinations. Social media filled with posts from Canadian travelers showcasing European castles, Asian temples, and domestic natural wonders, all implicitly contrasted with abandoned plans for American destinations. But perhaps most significantly, the immediate aftermath revealed how consumer boycotts can acquire institutional momentum that outlasts their original triggers. Canadian schools began organizing international exchange programs that explicitly avoided American destinations, while corporate travel policies were quietly updated to prefer non-American venues for conferences and meetings. You now understand what American tourism officials are desperately trying to downplay. This boycott has achieved a scale and persistence that suggests it may outlast the political disputes that triggered it, creating permanent changes in North American travel patterns. The unresolved transformation you've tracked through Canadian travel patterns reveals a truth that most observers are missing. This consumer boycott represents more than temporary political anger, but rather the emergence of a new form of economic nationalism that could permanently alter North American integration and provide a template for consumer-level resistance to great power pressure worldwide. What you're witnessing is the birth of lifestyle nationalism. The idea that ordinary consumer choices can be wielded as weapons of economic statecraft more effectively than government policies. Canadian families have discovered that their discretionary spending represents a form of economic power that can inflict real damage on American interests while requiring no government coordination or official policy changes. The success of this consumer revolt will likely inspire similar movements in other countries facing economic pressure from larger powers. Mexico, which faces similar trade tensions with the United States, is already seeing the emergence of Buy Mexican campaigns and informal boycotts of American products. European consumers, despite their government's official trade policies, are increasingly choosing to avoid American brands and destinations as political statements. The infrastructure consequences for American tourism will take years to fully manifest, but early indicators suggest permanent changes in regional economic structures. Border communities that built their identities around serving Canadian visitors are being forced to completely reimagine their economic futures. Some will successfully transition to serving different markets or different industries, but many lack the resources or geographic advantages necessary for such transformations. The timeline for potential recovery faces a fundamental challenge. Even if official trade disputes are resolved, the psychological damage from annexation threats and economic coercion may prove impossible to repair quickly. Canadian families who have discovered successful alternatives to American travel may see no reason to return, particularly if those alternatives provide better value or more politically comfortable experiences. The broader implications extend far beyond tourism into the fundamental nature of economic relationships between allied nations. The Canadian boycott demonstrates that economic integration, traditionally viewed as a source of stability and mutual dependence, can become a vulnerability when political relationships deteriorate. This lesson will reshape how countries approach economic partnerships in an era of increasing great power competition. For the global tourism industry, the Canadian boycott represents a preview of how quickly travel patterns can shift when political and economic pressures align with consumer sentiment. Destinations that have built their strategies around geographic proximity and historical relationships are discovering that these advantages can disappear rapidly when travelers are motivated by political concerns. The technological infrastructure supporting this transformation, social media networks that amplify alternative destination recommendations, booking platforms that facilitate non-American travel, and communication systems that coordinate consumer choices suggests that future boycotts could spread more quickly and achieve greater coordination than historical examples. Perhaps most significantly, the Canadian boycott is revealing the limits of traditional economic statecraft. American policymakers assumed that economic pressure would force Canadian compliance, but instead triggered a consumer response that may ultimately prove more damaging to American interests than any government retaliation could have achieved. What you now fully understand and why this insight matters is that you're witnessing the emergence of a new form of economic warfare where consumer choices become weapons, national identity becomes expressed through vacation decisions, and ordinary families discover they possess more economic power than they ever realized. The success of the Canadian tourism boycott will likely inspire similar movements worldwide, fundamentally altering how economic relationships function between unequal powers. The next phase of this transformation will likely accelerate regardless of official policy changes, because the underlying lesson for Canadian consumers is that their spending choices can influence international relations more effectively than traditional political participation. This realization, once established, will likely persist long after the current trade disputes are resolved. Stay alert for what happens next, because if consumer boycotts prove capable of inflicting sustained economic damage on major powers, it will transform how all nations approach economic relationships, making consumer sentiment as important as government policy in determining international economic outcomes. If you enjoyed today's video, consider subscribing to our channel, and I'll be seeing you in the next one.